Welcome to our video report. This is Ramesh Sigamani from Bravisa Temple Tree. It has been a celebration time for stock investors in India. Sensex has moved up above 5% in the month of October. This comes in spite of the widespread speculation that stock markets are about to correct. The reason for this positive outcome was through a slew of news flows. First one, India reaches 100th position in ease of doing business. India jumps 30 notches up in the World Bank ranking, getting into the top 100 countries in the world in where the doing business is at ease. Following this news, many international MNC companies are likely to set up manufacturing facilities in India, which is going to create huge job opportunities and thereby attracting thriving economic activity in our country. Money has been flowing into our country from all directions, retail, institutional, as well as foreign money. Following the World Bank report, FIIs who were selling India for the last 3 months have turned buyers. FIIs had moved out of India in the month of August, expecting a correction in the market when Sensex was at 32,300. Now, at 33,600, they have come back as buyers. This shows the confidence that India has even without foreign money. Actually, it is very good because until recently, when FIIs had a small amount of selling in their portfolio, that would create a huge vacuum in the markets. Now, whether it is FII or not, India keeps moving. The second positive news was good results from growth companies. The market participants expected to have a poor or negative results in the September quarter, which got proved wrong. Since 2016, financial services and metals companies were the biggest growth drivers in earnings numbers. In the current September quarter too, many businesses or many companies from these sectors have registered good growth numbers, while there had been some misses and negatives in the public sector banks, telecom and pharma sector, which was expected and is not likely to create any big impact in the market. Companies in the non-banking finance sector, housing finance companies, specialty chemicals and metals have had extreme rallies which brought in huge investor confidence that took the Sensex to greater heights. By holding best of businesses from these sectors, our portfolio managed a euphoric 9.55% return in the month of October alone, which is almost double than what Sensex made in the same period. In the last 1 year, Sensex has grown 24%, and our portfolio in the same period has managed a whopping 46% growth in 1 year. So, what is going to go wrong? There is concerns building up that there are uncertainties in the elections that are going to come up in Gujarat and other state governments. There can be challenges which can trigger the most expected correction in the market, which has been pending for the past 6 months, while we expect this correction is not going to be steep because there have been several positive factors that have been supporting our country, which will keep our markets on the upswing. And use this correction as an opportunity to churn and review your portfolio by moving out stocks or holdings that are not at par with Sensex returns and replace them with better performing schemes and stocks. So, to sum it up, India at the 100th position in ease of doing business, good results from growth companies, and uncertainties from the upcoming elections. Time to churn up and review your portfolio. Get ready for the next big rally in the market. SBI has cut interest rates on its FDs from 6.5 to 6.25%. Soon, other banks are likely to follow. If you are in the 30% tax bracket and have been an FD investor, it is time to move your investments to arbitrage funds, which has been giving 6% returns, and all these returns are tax free. That is the advantage between bank FDs and arbitrage. Bank FDs is taxable on your slab, while arbitrage returns comes tax free. So thank you. This is Ramesh Sigamani from Bravisa Temple Tree signing off. Have a great day.